Hello everyone, welcome back to my YouTube channel. In today's video, we are going to start this series with a understanding of what is credit risk and why credit risk is so important that all the banks and all the financial companies are investing so much in this. So without wasting time, let me take you forward. So we would talk about credit risk. So there are a couple of questions which will obviously come. What is credit risk and why it's used and how this is calculated? So let's go step by step. So just understand that one entity is bank and the other entity is customer. Now all of us have a bank account, either savings account or current account or any type of association with the bank. So sometime what happens when we go to bank and we ask the bank that I need some loan. So you go to the bank and ask for a loan and you do a application. Now, on the basis of your application, bank have so many actions to do. Either they will reject your loan, either they will accept your loan, or they will put it on hold. So the third situation is very rare. Either it's rejected or accepted. So let's say bank send you notification that they have accepted your loan. So your loan is accepted. Now the bank has given you, let's say, 10 lakh rupees. So the loan has been given to you. Now you have to pay back this loan in monthly EMI in the form of EMI. So every month you are paying a small chunk, okay? Now what is credit risk? I'll give you a definition. Basically, credit risk is the possibility if a borrower will default or not. To calculate this possibility whether the borrower will default or not is known as credit risk. Now, bank is known as lender because they are lending us the money, and customer is a borrower. So now if the borrower is not able to give the money back to the lender, so obviously the lender will have some loss. So to cover that loss, bank always measure credit risk. Why it's a credit risk? Because they are giving you a credit and that credit is on a risk factor. And what is the risk? Of losing the principal plus interest. Not just principal. Let's say they gave you a 10 lakh rupees loan. Now the amount which you will pay back to them, capital plus interest, is let's say 12.5. So this 12.5 lakh is the total risk which bank have, not just 10 lakh rupees. That's how we define credit risk. Now, before giving you loan as a customer, bank is checking so many things. Okay. So basically bank check the credit worthiness of your customer. We call this term credit worthiness. Now how bank do that? So bank will check the 5C. We call them 5C of credit risk. Now what are the 5C? 5C in a customer. Let's say I am a customer. So bank will check this 5C in me as a customer. That is character. How's the character of the customer? Then what is the capacity of the customer? Like how much loan we should give to the customer? What is the maximum capacity he can handle? Then the collateral. Like if the customer has something to give us back in case the customer is not able to pay the loan. Let's say in the case of a house loan, your house will be counted as a collateral, because if you are not able to meet the financial obligation and if you are not paying the amount bank, then bank will sell your flat or your house and then they will recover the money. Now, conditions. What are the conditions of the economy of that country where they are giving the loan? What is the overall analysis of that area, like in terms of GDP, in terms of income, everything? And the fifth C is known as capital. So these are 5C of credit risk which bank always measure before giving the loan. Okay. Now let's talk about, we have already spoken about what is credit risk, why we calculate it, because to avoid the condition, if a borrower is able to repay the loan, bank how will measure that and bank how will accommodate that risk, that is known as credit risk management. Now how they calculate, I have given you a basic overall. These are the 5C. But let me give you one more example of a credit risk situation. Then from next video onwards, we'll go more in detail. Now, what is the example of a credit risk? So you might have heard in 2008, United States of America, there was a recession. All of us know about it. Why that recession happened? Because majorly there were so many house loans given to so many people and without checking their credit worthiness, whether they will be able to pay the loan or not. Then what happened? Eventually people were not able to pay the loan and there were so many houses were built, so they purchased basically houses. Okay, now suddenly people started selling these houses because they were not able to pay the EMI. So basically the supply was increased. There was so many supply of houses, but demand was not there. And if you understand this concept, if supply is high and demand is high, then the chain is balanced. But if the supply is high and demand is not there, so there were not enough buyers in the market and seller were so many. So because of that, people were not able to pay the EMI bank to the bank, and the biggest bank which was actually got almost demolished at that point of time, that was Lehman Brothers. Lehman Brothers, because it was the one of the largest financial sector bank in United States and also Bear Stearns. So these two were the like fourth and fifth largest bank in United States. Both of them actually collapsed. So that's the reason this whole credit risk picture came into scenario, that now all the guidelines will be so much stringent so that there is no scope of ultimately default. What is default? Now, if a customer is not able to meet the financial obligation, whatever he has to pay, and he declare himself that I cannot pay the money back, that situation is known as default. So basically, to avoid the default, all this situation was created by the regulatory. Now, you should remember these terms, okay? Let me write regulator. Now, what is regulator? Regulator is a body in any company, in any country basically, where they actually govern the whole financial system. Like in India, you have Reserve Bank of India. So I hope this makes sense to you guys as of now. So today it was a moreover introductory session, that what is credit risk, and in the upcoming video we'll go to the other pointers of this, like what is PD, LGD, EAD, estimated loss, then risk weighted assets. All those things we will cover, and then how the approach are there, like which bank use that to manage the whole credit risk scenario, like how they manage this IRB approaches, then AIRB approaches. So these terms are pretty new to you, I'm pretty sure, but I will explain each of these in the next video. Now, Also, one more thing, whatever the important notes will be there, I will put in the description box the link, and you can download it from the GitHub repository, and you will be able to get all the codes which we'll create in the upcoming session, and also the notes like this. So on that note, I will take a leave from all of you. I'll see you in the next video. If you like this video, please hit the like button, and please put a comment, and please share this video with your friends. All the best, guys. I'll see you in the next video. Thank you so much.